We're back at overtime. Stocks pulling back slightly today. Altimeter Capital's Brad Gerstner saying just moments ago, now's a good time to reposition for 2023. Joining us now to discuss is Gabriela Santos of JP Morgan Asset Management and Keith Lerner of Truist Wealth for their reactions. Great to have both of you with us. So as we try and position Gabriela to 2023, I thought it was pretty telling as he was talking about this massive re-rating that has taken place in certain parts of tech. All of tech. The Nasdaq's down 27% year to date. But there's a certain part of tech that remains no touch to many people in this market because of where rates are, where the Fed still might go. Is that how you see it as well?
We've seen a massive re-rating across asset classes, broadly speaking. So we're feeling, just in general, much more optimistic about returns over the next 10, 15 years. In terms of tech specifically, I think one of the carryovers from this year is going to be the return to positive real rates and the end of acronym investing. So it's going back much more to us to overlaying in each sector we invest in, both the quality and the value factor. So within tech, we see plenty of optimism, especially still for business tech-related stocks where we have growth at a reasonable price. So we are seeing opportunities within semis, within software, within cyber, within cloud computing. It's just overlaying those quality and value factors going forward. You know,
Keith, on that note, I think maybe one of the biggest questions is, and it plays off of what Gerstner was saying, determining what that reasonable price is the toughest question to answer right now for those types of stocks.
Yeah, well, first, great to be with you. First, as far as the overall market, we actually would be fading this market strength. We think the upside is capped. And more specific to technology, you buy tech because earnings momentum is stronger than the market. That's not what's happening today. Earnings momentum is at a fresh relative low, at least over the last year. And then you look at relative valuations for the sector, it's still trading at a 25% premium relative to the overall market versus an average of about 7% over the last 10 years. The other thing, Scott, you have to remember, these stocks outperformed by so much over the last decade. So yes, they're down a lot. Yes, there's been a reset, but we're still underweight the sector, and we do not think they're likely to be leadership next year. So we remain underweight, and it's not something where we see a lot of value today.
One thing that you said to our producers, Gabriela, is that you say it's the best entry point for long-term 60-40 investors since 2010, at a time where I think we're still questioning the viability of a 60-40 portfolio.
And here's where I think we have to separate strategic versus tactical asset allocation. If we're thinking about long-term returns over those next 10, 15 years, we have higher rates. We have a better entry point for equity valuations. So just over the last 12 months, we've upgraded our expectations for long-term returns for a 60-40 from 4.3% to 7.2%. So strategically, you can get much better returns. But tactically speaking, that's where we would still not be too trigger happy. We would still be underweight risk going into the first quarter of the year, where we still have some unanswered question around inflation rates and recession pricing.
So, Keith, do you not think that stocks can put a good rally together between now and the end of the year? Yesterday was just a fool's move, and today is a precursor of what lies ahead once we come back to reality, so to speak?
Yeah, today is actually pretty reasonable. You pull back. There wasn't a lot of selling pressure. You had a big day yesterday. So I think the biggest positive for this market is position is still somewhat light. We all know we're in an area of positive seasonality. A lot of that happens towards the back half of the year. But, for our investors, we're not looking just for the next month. We're looking for the next 6 to 12 months at minimum. And if we think recession risk are relatively high, which we do, if we think that earnings risk is pretty high, which we do, and you look at the market multiple today, you're trading at a 17.6 forward earnings for the consensus earnings today. If you look back before the pandemic, the top end of the range was about 18 to 18.5. So we just think, even if you use really optimistic numbers today, maybe the upside is 4,200, maybe really generously 4,300. That's 3 to 5% upside. We think the downside is much greater than that. So therefore, we would be, at this point, overweight fixed income, more high quality fixed income. We do think there's opportunities in the equity market, but we think it's below the surface. The equal weighted S&P tilted towards value. And we think, just like this year, investors will continue to have to be more tactical, taking advantage of these big swings in both directions, which is likely to continue next year.